Hello everyone, this is Abhijit and Rohan Singh recording our Charts Are Fun weekly session. This is for the week of August 5th, recording after the close of market on August 9th. Boy, did we have an earthquake in the market this week. It's been really a roller coaster. Started off with Monday morning, everyone woke up, a huge crash in the Japanese stock market. Their Nikkei fell over 12%, almost mimicking their fall since 1987. There's a big concern about the yen carry trade that kind of unraveled, causing this big crash. US had recently, started weakening, and as a result, there was quite a bit of expectations of a rate cuts coming in. And what triggered this off was Friday, US job data was pretty weak. Unemployment shot up to 4.3 from 4.1. The expected jobs to be reported for July was over 175,000. We only got as low as 114,000 jobs. So market got nervous, thinking that US rate cuts were going to be coming. Japan has done their second rate hike. After over 17 years, they had their first hike in March this year, and they had their second hike in last Wednesday. So the differential, which in a classic yen carry trade, people borrow cheap yen because their interest rates are close to zero for so many years. So borrow the cheap yen currency and then make that investment in other stronger currencies with those currencies just have bigger returns. And especially with if you put it in treasuries, put it in interest rate differentials where the interest rates are higher in those other stronger currencies, you can make a quick carry trade as a result through some form of an arbitrage. Now, turned out that yen, which had weakened a lot this year after those interest rate cuts, had started strengthening, and from something around 160 plus, when even the Bank of Japan had to kind of intervene to make not the yen fall any further, had fallen to the low 140s this week on the strengthening of the yen, unraveling of the carry trade, and that overall shook up the markets. All assets across the world sold off, and in particular, we woke up on Monday, and boy, did the US markets, the growth stocks, those classic Magnificent Seven, the AI powered stocks, took a big hit. So let's go look at the charts. Let's see what the charts are telling us. This time we will walk through our classic, the usual 10-year yield chart, look at TLT, is that setting up as a good trade? Look at the tech sector, in particular QQQ and XLK, that's the tech sector spider, and look at the other two aggressive sectors that have done quite well, the discretionary XLY, the communication services XLC, and also we will start looking at just the overall growth versus value. Where is that headed? So with that, let's just look at the charts and go through the analysis. So this is our blog site in Substack, chartsarefun.substack.com. We publish daily blogs. You can just go check out an archive and you'll see all our blogs here. If you just subscribe, it's free with your email address. You'll be getting notified with an email of the blog. Usually in the first thing in the morning, they get posted around 7 a.m. So you'll get a copy of those blogs as soon as they get posted. Also, our YouTube channel, Charts Are Fun. It's really all about charts are fun. We hugely believe charts have tremendous potential. We're not registered investment advisors. We're not giving investment advice, but we're showing you how to read charts, how to use charts to be able to use in investing decisions. So you're going to talk about some of those patterns in today's analysis, in today's video. But here are our previous videos weekly. Welcome to go take a look. We appreciate you subscribing to our channel. And also if you like the videos, we can hit the like button. So everything started with, look at that waterfall crash. Look at that huge drop from a level of 42.4K around early July. That's when it peaked. That's when a lot of the other growth sectors, the Magnificent Seven stocks peaked as well. Pretty much what happened there was middle of July was when the CPI data came out. That's effectively a point when CPI data had a negative print month over month. Meant that we are now getting ready for inflation. Inflation anyway had gone up a bit in the beginning of the year, started coming down, and now there is quite a bit of expectation that the Fed is finally ready to start cutting rates. So that negative print in CPI got, of course, a rotational move in the US. The small caps took off, but many of the other emerging and strong sectors, our markets got hit. So Nikkei 42.4 was around that same time, but since then it's been falling. But it had hit reasonably good support at 37.6, which we saw in the past. It rebounded up multiple times. However, after the weak jobs data that came on Friday, Monday Nikkei opened, that carry trade unraveled. People got nervous about US rates coming down, which effectively kind of negates the differential that they had. And then, as you said, the Bank of Japan had raised rates twice this year with an indication there would be further rate hikes. So here, when US is in the process of cutting rates, we had the Bank of Japan hiking rates in Japan after a duration of 17 years. So that was the huge waterfall, 12% decline in the Nikkei, touching a level at 31.2K. Of course, that was the earthquake. And so far, the aftershocks only came briefly on kind of Wednesday's trading, but the last couple of days, the market has rebounded back. And we can see that it was a very sharp, call it a dead cat bounce, but a sharp rebound of the Nikkei back to close that gap near 35.8K. And since then, it's been consolidating that move. Now, the question is, are we done? Or are we going to expect more of unraveling of this yen carry trade? So let's look through some other charts to read the tea leaves and see where we think that could go on. Now, a key FedWatch tool that's published by the CME group tells you about the probability of rate cuts. And this one right now is showing us for the 18th September when the Fed meets, 50-50 chance between a 25 basis point cut versus a 50 basis point cut. So we can see 50.5% for a 25 because 500 to 525 basis points is just a 25 because we have 525 to 550 right now. So that's a 25 basis point getting us at 50% probability and 49.5, slightly lower probability than the 50.5 for a 50 basis point cut. You won't believe it. This probability had gone up to 98%. If you had come to this website on Monday when the market was tanking, looked at it, this is when Jeremy Siegel, the Wharton professor, was out there in CNBC making a request to Fed to do an emergency cut of, he had talked about a 75 basis point cut. That's how aggressive he went in, asking, for that kind of a deep cut. And he had felt that there would be two such cuts, a first cut coming in emergency cut and the next one coming right after in the span of September when the Fed met for its next meeting. Well, that was, of course, huge fear in the market caused that kind of an expectation. Since then, the market did rebound, nerves did cool, and now it's a 50-50 cut between a 25 basis. There's, of course, 100% probability of a cut for sure in September, though Jay Powell last week didn't quite say it. He said it was data dependent. He was going to watch in 2 more jobs data and 2 of CPI data. Well, the jobs data was bad, so that kind of definitely, would have tweaked him to kind of go towards the September cut. And now with CPI data coming out next week, if it continues to weaken, we continue to see the downward declining trend in CPI. There's a good chance that then the rate cut in September is solidified. CME tool is giving us 100% probability of that cut. Now, the next chart we're going to look at is what happened to the S&P 500 in the past historical. And this is a classic chart that Tom Bowley, who I really admire, is a technician on stockcharts.com. He has his own site called earningspeech.com shared. It's about historical trends when unemployment rate starts going up. And we can see that unemployment rates historically in the past have gone up in the early 90s. When it went up, market initially took a dip, but then from there it started climbing. However, in the more recent past, what we noticed, like in the dot-com crash, when unemployment rate started going up, so did the coming out of an inverted yield curve. So we had briefly, for a short duration, had inversion of the yield curve. And then as the yield curve started steepening, we got a pullback in the market. So we know that was the dot-com crash. Took over 2 years to bottom out. Then we got the financial collapse, the financial services sector collapse, right? That collapse, we can see same unemployment rate went up, yield curve was briefly uninverted, and then it started from inverted yield to uninverted, and then it started steepening. And as that happened, the market pulled back quite aggressively. These two were sharp pullbacks. More recently, during the COVID, the curve had not inverted, it had almost come to zero. And then as it started steepening, turns out that there again, we did get a market sell-off, but this is more of a misnomer because you'd say many ways that this was more of the COVID pandemic related, tank in the market. Can't exactly be correlated to what's happening now. However, we do have drawn through the purple vertical line here, we just about, after the longest duration in an inverted yield curve situation, we're just about to begin to steepen. So if yield history is a past, steepening initially does cause a market pullback. We should perhaps be gearing up for such a pullback. So from 55.22 was the closing high, but we know that we got, and this is a monthly chart on a monthly basis, but we know that we hit 56.70 literally just late in the July timeframe. And from there, we've pulled back, about 300 points. We had pulled back even deeper, hitting closer towards the 51.20 level, and from there have rebounded. But right now we closed at 53.44, 53.44. But we could expect to see a market pulling back as the as the yield curve from inversion uninverts and starts steepening, and as unemployment rate starts going higher. We know that unemployment rate was as low as 3.4% last year, middle of last year. From there, it's crept up to 4.3. So with the next job data coming up in first week of September after Labor Day, we're going to see what happens to this if it continues. And usually that's a sign of a weakening economy, sign of a weakened economy itself would mean that the market would reflect it, and hence the market pullback should not be unexpected over the next few months. Another thing that cannot be ruled out, which Tom Bowley nicely highlighted, is the seasonality from the US presidential election year. So he took from 1952, 18 presidential elections, averaged out the market over the, that election year. And turns out, if you notice, election years, average over the last 18 such election years, had a very nice climb for over the summer timeframe, like from spring, from March through the August timeframe, and then it gets a pullback. It gets uncertainty. The election comes in towards that a couple of months before the election. Uncertainty causes, market never likes uncertainties, to who's the candidate would be that would win, what policies would come with that candidate. Uncertainties cause market to pull back, and then it takes off after the election results were announced. Now, this year in particular, we see that there are two pullbacks seasonally when Tom Bowley painted this out. One is in the early summer time frame, and the other one is towards the fall time frame. Well, this one we know was shown in May to the July time frame. We know that this time our pullback came actually in from March to April, and from April we have been on an absolute climb. So this shows a pullback starting in September, but we know that this shifted by a month, and this pullback that we got actually came starting from first week of August. So this is something we could have effectively shifted this window. We could be seeing a couple of months of this pullback continue, and then maybe bottoming out sometime in late September is what we can expect. Maybe even early October is when this can happen. So that's another thing to keep in mind is presidential election years, averaged over last 18 election years, expect to see some kind of a pullback weakness in the market leading to the election. Another thing to be looked at is VIX has shot up. Boy, did it shoot up, call about an earthquake in fear index. This shot up to 65. We haven't seen 65 till before the pandemic when it hit 87 or so. So that was a big spike in VIX. Even during the bear market pullback in 2022, we did not see levels as high as 65. It hit the high 38, 36, and from there pullback. However, when we are in a situation where VIX stays ranged between 20 and higher, and this is also a bullish cross or a cross of the 20-week moving average. These are OHLC bars with each representing a week of trading. We notice that when the 20-week goes above the 50-week, 20 in this case in red, the 50-week average is in blue, and stays in above that, we tend to see a market that corrects, a pullback in the market. In a similar way, we just had a bullish cross of the 20 above the 50 with these VIX spike that we got over the last couple of weeks. This week we got up to 65. However, we did pull back and close closer to the 20, but expect 20 now to be a reasonable support level. And if for the next few months we expect this VIX to be range bound, What will that result in? It'll result in higher volatility, bigger movements in the market. 2 to 5% would not be ruled out every few days, something to look at. And this could mean that we could have an overall correction continue in the market. We see that the correction has just begun here from that peak that we saw around 56.70 or so early July to now we're 53.44. But this could continue as the VIX stays elevated, something for us to also look into. Next thing to look at is what is the 10-year yield telling us. This was a classic descending triangle 10-year yield breakdown below the 4.2% to 4.73 was the peak that it touched in April. This was measured to somewhere around 3.63%, and we hit 3.66, very close to that measured target on this descending triangle. We can clearly see here that 10-year yield now is on a declining path, and that means that when you look at an ETF that ties to long-term treasuries, in this case to 20-year treasury TLT, that broke out of a beautiful inverse head and shoulder. A neckline is around between 94 and 95, a left shoulder here at 90.2, head at 86.18, and then the right shoulder at 89.5. If you measure the depth of the head from 86.18 to 94.23, that's 8.05 at 8.05 to 94.23, 102.28. That's the target that the TLT, the 20-year Treasury ETF, is headed towards. So we got a spike to 99.9, pull back sharply, but then on declining volume. The breakout was on heavy volume. Smart money might be looking for the correction to continue and TLT to continue its climb towards the 102 level. So that's something to look at as an alternative to investing in stocks. Looking at investing some in treasuries may not be a bad option, looking at where we closed at 96 today. Another 6-point move towards 102.28 can't be ruled out. Now, what did the QQQ chart do over the last few weeks? We noticed from that early July, while S&P topped out closer towards that 56.70 level, QQQ topped out at the 503. Now, it didn't quite meet the target that we had expected on QQQ from a weekly chart, where we can see a beautiful cup and handle from 401 to 251 back up to 385. That's roughly like 134 points. At 134 to 385, that measures closer to 519, 520. That was the target. It didn't quite meet it. If we take a channel here, rising channel for the lows, and we take the parallel line to this bottom end of the channel and draw it to the top, it met exactly at the top of that channel at 503, joining it from the previous high at 329 in the 2022 level. That is where the bottom of the channel trend line is where QQQ came and tested, right very close to 420 and bounce off it. That also happens to be the rising 50-week moving average, which is a long-term trend line. So that could be perhaps a bullish reversal, and we could maybe resume the climb, but this is something to be watched at. Bulls are not yet lost the race here. There's a possibility that we could now, having closed with a nice reversal off the bottom from 420 up to 450, that's a 30-point reversal in QQQ, close with strong volume, a bullish looking candle, opening at the lows and closing at the highs of the week, and RSI pulling back on the weekly to the 50 line. And in a bullish trend, when we have a bullish continuation, RSI usually rebounds off the 50. So QQQ chart on a weekly looks quite bullish. It kind of pulled back from the top of the channel to the bottom of the channel, tested it successfully, rebounded off that level, very close to the 50-day test, and off that bottom of the channel, and on strong volume. No foul. QQQ looks perfectly valid and perfectly bullish. Looking at the technology ETF sector spider, which is XLK, that also has an upside higher than where it pulled back from. It pulled back from a top near 238, but let's do the measurement. The cup and handle here is from 173 to 111, moving up to 180. So that's roughly, we're talking about 69 points from 111 to 180. At 69 to 180, that's 249. We didn't quite get to 249. We got 238. Pull back, but also a nice rebound off the, in this case, it also rebounded off the 50-week moving average. Pullback, tested, closer towards that 50-week, rebounded off it. strong volume on the rebound, bullish looking candle, opened at the lows, closed at the highs of the week, and also RSI testing that 50 to 45 to 50 level, which is a level where bullish trends always rebound and continues back again on the climb. So far, XLK and QQQ charts both look quite attractive. However, if you start looking at the measured target on this breakdown of the XLK chart, we can see that 210 was kind of a support level. It had a peak at 238, that's 28 points. Subtract that from 210, you get a measured target near 182, which was the low from the early part of the year in January. There's a possibility that this could be where XLK could pull back to. We did get a bounce from the 190 that we tested to test the support, which is now resistance from the bottom, declining volume. So volume has not been as strong in the daily chart as the rebound came. What if this fails? Well, if this fails, you can expect the break of this and to go back and test 182. There's some negative signs here, negative divergence in terms of a lower high in RSI as XLK moved from 232 to 238. So that was the topping signs indication, and that's how the top happened. There is distribution going on. We can clearly see that AD line is declining. Lower lows on AD line indicating distribution from smart money, heavy volume in the sell-off once it broke 210, heavy volume, and low volume on the snapback rally. And also underperformance of the technology sector, which has been leading in this entire market rally of the April bottom. We can see that the XLK was outperforming S&P 500 from that April all the way up to the recent peak near mid of July. And from that CPI data print, rotation happened out of the technology, Magnificent Seven stocks, money moving out of that into small caps. And this has been clear weakening trend underperformance of XLK to S&P. So those two, distribution underperformance here, low volume on the snapback, could indicate that perhaps we may get a failure of this at this resistance level and pull back down again, this time testing 182, the January level. That's something to look at. It cannot be ruled out. Further, this is a weekly, longer term, 12-year weekly chart of XLK. We can now see the negative divergence in a more broader fashion. Across 2023, through the recent high, higher highs in price, lower highs in RSI. That's a negative divergence on a longer time frame on that same weekly chart. Guess what happens to PPO? Same negative divergence. Lower highs in PPO, lower highs in RSI, while price climbs higher. That is more of a bearish outlook on XLK. And as a result, same thing going on with the relative performance to S&P. Relative performance forming lower lows, as you can see, as the price is climbing higher highs. That also indicates that market is beginning to move out of technology stocks, perhaps into other sectors. Now, what about other growth and strong names, sectors like the technology sector? One such is discretionary. Guess who are the key stocks of the discretionary? The two top weighted, Amazon and Tesla. We know both had very bad reactions to earnings in the recent earnings. And this we can also see a classic breakdown from 180 to 194. That's 14 points. Subtract 14 from 180, you get 166. That met the target. So it broke down, heavy volume, gap down, met its target 166, but snapped back now, testing that 200-day moving average, in this case from below with lower volume. So far, not looks more like a dead cat bounce than a real bullish reversal. Unless it can take out the 200-day, volume can increase and the trend, the gap here at 180 gets closed and we continue on an upward trending climb. Till that happens, this looks a bearish chart as far as I'm concerned because of the low volume in the snapback and also likely failing at a very significant resistance now at the 200-day moving average. This is what we could watch next week with the CPI print. The other key sector, Meta, Google, these are the internet sector stocks. That has been on a roll as well from the April lows at 76 going up to 87. From there, it got a pullback after the earnings that came out. Only Meta did very well. That's what got the XLC back from 82 to 87 of Meta's strong earnings. However, pullback, 81, coming back again on declining volume on the dead cat bounce. likely fails at, it did slightly take out 85 is the 50-day moving average. It took out slightly above it, but likely fails here moving into next week. And if it starts declining, this measured target from 81 to 87 or 88 is roughly 7 points. Subtract that from 81, 74, 75 is where we are headed on that, right near the late January levels of 75, 74. That's where we think XLC could head, also a negative factor. Finally, we want to look at growth, the Russell 1000 in this case, growth versus value. IWF is the growth ETF and IWD is the value ETF for Russell 1000. This is on a very, very steady decline. So growth weakening over value. We can see the underperformance. This is the ratio. Underperforming, setting up lower lows, lower highs across down this channel. Well, we got that pull back to the 1.84 level, which is also the April low, and rebounded off it. So far, no foul. It is within the channel, but if we are not able to take this declining channel and start going above it, this needs to be watched out, and we could then head back lower, this time go below the channel, something to be looked at. So this is something to be considered, that we might be in a situation where growth is less favored into the uncertain period, into the election volatility coming up. If volatility stays, VIX pull back as we showed from a level near 65 closing near 20, but if 20 now holds a support, market continues to weaken, continues to sell off. Volatile movements, up and downward swings both directions, and not just selling off every single day, but upward movements followed with sharper downward movements. VIX continues to stay above 20, and the seasonal effect as we showed in here in Tom Bowley's chart, with a couple of months of seasonality. We started that off with the earthquake that we got from the, carry trade Japan crash on Monday. Other economic news, key is CPI next week on Wednesday. Then we have NVIDIA's earnings and Jackson Hole. So Jackson Hole is the week after, and the Friday of the week after, and then NVIDIA earnings is finally the last week of August, on August 28th. So all those three things are market moving. They'll have big impact. Market now has begun to watch economic news like a hawk. Any bad economic news is bad for the market. We got a good rally this Thursday because unemployment claims were weaker than expected. We didn't get as many unemployment claims as last week. So that helped the market rally a bit, thinking that maybe the job market isn't as bad as we were fearing with that 4.3% unemployment print on August 2nd, last Friday. So the unemployment claims being slightly weaker than expected helped the market rally, but next week's data will again be key. Let's see what CPI does. If we continue on that downward path, we could not rule out that XLK could be headed towards a target near 182. We could expect to see the discretionary and the communication services to fail at their respective 200-day moving average and start declining lower. So with that, thanks for staying with us. Appreciate you listening in. Good luck next week.